Hello, everybody. This is Hardinder. In this video, I will be going through the solutions to additional practice problems for topic 3, passive investments. There were 3 questions in total for practice. The first one spoke of Portrait Inc., which on Jan 1st, 2001, bought $500,000, 6.5% bonds of Swan Limited for $486,527. Of course, we can see that the face value of the bonds is not equal to the acquisition cost. When that happens, we cannot presume that the bond rate is also the effective interest rate. We must calculate the effective interest rate on that date and use the effective interest rate for computing the interest, so preparing the bond amortization schedule. The bonds will be paying annual interest on December 31st, and they would be maturing on December 31st, 2007. So that's the first thing to do. You want to calculate the effective interest rate. So we have face value, annual coupon payment, number of years to maturity, the market interest rate at the time of acquisition. Sorry, that's the one that we have to calculate. So I'll just leave it here for the moment, and PV, present value. The purchase was made on Jan 1st, 2001. The bonds have a face value of 500,000. The coupon rate is 6.5%. So every year, the bonds will pay interest at 6.5% on 500,000. That's $32,500. The number of years to maturity from Jan 1st, 2001 to December 31st, 2007, well, that's 7 years. So that's under the number of periods. The interest rate is what we must calculate. So I'm going to leave that blank for the moment. And the company's paid 486,527. 486,527. Right, so we want to calculate the interest rate. The formula using Excel is rate, or if you're using a financial calculator, it is the formula for I over Y. So what we have to input here is the number of periods, which is 7, the annual coupon payment, which is $32,500 we will be receiving. The company is going to be receiving $32,500. The company has paid the 486,527, so indicate that as a negative flow. And then the company will be receiving $500,000, so that's a positive cash flow. Close and press enter. So it says 7%, but we want to be double sure. So check, yes, it does indeed seem clearly 7%. That is the effective interest rate. 7% was the rate at the time the bonds were purchased. So we want to use that rate to prepare an amortization schedule. This will be for the purposes of determining the interest income on the bonds every year. So 5 columns: date, the cash, the amount of interest that's included in the cash, the amortization, and the balance. Now we're going to be beginning with 486,527 as of Jan 1st, year 1. Every December 31st, until December 31st, year 7, the company will receive $32,500 in interest, the coupon interest. Of course, the interest income will be calculated based on the effective interest rate of 7% multiplied by the beginning of the year balance on the loan. And I just like to round numbers to the nearest dollar. So I've got that. So the first year's interest income is actually going to be 7% of 486,527. That works out to $34,057. Of course, the cash amount received is not enough to cover the interest. The difference acts as negative amortization. What negative amortization does, like amortization will lower the balance, negative amortization will basically increase the amount of the investment balance. And we expect that to happen because we expect that over the 7-year period, the carrying amount of the investment will go up to 500,000, and that's precisely what happened here. Every year, the interest amount is calculated, it grows, and the negative amortization causes the balance of the investment to keep growing. So we did that, and the reason for doing so is that the company was accounting for its investment under the amortized cost model. On Jan 1st, 2004, Partridge decided to reclassify its investment in Swan as FVOCI. So Jan 1st, 2004 basically coincides with December 31st, year three. At that date, the company decided to reclassify its investment as FVOCI, fair value other comprehensive income. Now, something that we need to note is that investment in debt securities can be reclassified. When a reclassification occurs from amortized costs to fair value other comprehensive income, we want to measure fair value on the reclass date and record any adjustment in other comprehensive income. So we'll come around to doing that calculation. Before we do that, let's look at what the requirement was. The question asked for preparation of partial statements of comprehensive income for the years December 31st, year 3 and 4, and statements of financial position, year 3 and 4, showing how the information for the above investments will be reported. So here goes. Let's prepare the partial income statement, Partridge Inc. Statement of comprehensive income. And year ended December 31st. We're making one for year ended December 31st, 3. So December 31st, year 3. The information pertaining to the investment, well, what are we going to report here? We're only going to report the interest income. So this amount, $34,282, and that will be reported under other revenues and expenses. If the company was preparing a multiple step income statement portion there, under other revenues and expenses, we will be reporting interest income from AC, or just interest income is fine, 34,282. And then for the statement of financial position, at December 31st, year 3, the investment will be reported under long-term investments, investment in Swan bonds, amortized cost, and it will be reported at amortized cost, which was, as of December 31st, year 3, 491,532. So those are the two relevant numbers as far as year 3 are concerned. Now, on Jan 1st, year 4, the reclass occurs. The company, Partridge, decides to reclassify the investment as fair value other comprehensive income. The market interest rate on Jan 1st, year 4 was 6.8%. So when the investment is reclassified from amortized cost to fair value OCI, we need to measure fair value on the reclassification date and record any adjustment in other comprehensive income. Mind you, thus far, we were using amortized cost and we did not bother to make any fair value adjustment. Now, when the decision is made, so I'm going to insert a few lines here to make life easy. So as of Jan 1st, year 4, if we were to do the calculation, the face value of the bonds is still 500,000 and the coupon payment is still 32,500. Now, from Jan 1st, year 4, the number of years remaining to maturity is 1, 2, 3, 4, because 3 years have already passed. The market interest rate at that date was 6.8%. So 6.8%, putting that in. If we calculate present value, so PV, the rate is 6.8%. Number of periods, 4. The annual coupon payment is 32,500, and the face value is 500,000. So if I calculate that, I get 494, 896, and 16 cents. I just like to round it to the nearest dollar. 494, 896. Now, our carrying amount on this date is 491, 532. So what will happen as a result of the reclassification is we will record any adjustment. So we measure fair value, and then we record any adjustment as in other comprehensive income. So I'm going to start noting the fair value here. So fair value, this is the point that we did. So December 31st, year 3 and Jan 1st, year 4 are basically coterminous. They're basically the same time, right? Like just the very next date. So something to keep in mind with bonds and bond investment is that the difference between the fair value and what the balance would be under the original effective interest amortizations is computed as other comprehensive income. Now, the fair value of the bonds is more than the carrying amount. So the $3,364, well, that becomes the initial other comprehensive income. All right, so there is OCI resulting from the reclassification. Then subsequently, on December 31st, year 4, so now what needs to happen is that we have to prepare a new effective interest amortization schedule, because this effective interest amortization schedule is no longer in play. We want to prepare an effective interest amortization schedule. No, hang on. That's not correct. The effective interest amortization continues as it was from before. We have just made a reclassification from amortized cost to fair value other comprehensive income. We will continue to report interest income using the original effective interest rate. So for year 4, our interest income will be 34,407. But we will calculate the fair value on the bonds using the market interest rate on December 31st, year 4, which is 6.4%. And that works out to 501,327. So as of December 31st, year 4, the fair value is 501,327. The balance in the amortization schedule using the original effective interest rate would have been 493,439. We will this time around be reporting the investment at fair value, which is 501,327. What that means is that our accumulated other comprehensive income is going to go up. Well, it's now 501,327 minus the 493,439. So that becomes $7,888. So there is a further increase in other comprehensive income or additional other comprehensive income of $4,524. Now, mind you, both of these occurred in the same year. So we can actually record the total $7,888 as being the other comprehensive income for the investment in Swan bonds for the year 2004 in other comprehensive income. So let's see what happens in year 3. Maybe it's not a bad idea if I kind of showed the numbers comparatively. So here goes. We'll make 2 columns. So for year 3, the amount that we reported for interest income was 34,282. For year 4, the amount reported as interest income is 34,407. Still basically the same original effective interest amortization schedule, not changing any of that. But what will come in addition in year 4 will be the OCI, other comprehensive income. Now I'm ignoring the deferred tax component because we have what we have is we have $7,888 in total other comprehensive income. OCI is reported net of tax. So this company has we don't know what the tax rate was. So if we knew what the tax rate would have been, we would have reduced the $7,888 by the applicable tax amount and reported OCI net of tax, net of the deferred tax. We're not going to bother with the income tax portion just yet. So just pretend that we're reporting this without the tax effect. So OCI, we have a holding gain on the investment in Swan. So OCI, other comprehensive income, we have you can call it a fair value adjustment, you can call it holding gain or loss, you can call it unrealized gain or loss. I just like to call it a fair value adjustment because that is kind of, it captures the sentiment, fair value adjustment on investment in Swan. And so there was nothing as far as other comprehensive income for year 3, but for year 4, we will have 3,364 plus the 4,524. That's a total of $7,888. As far as the balance sheet goes, if we did a similar thing, then the balance sheet, if you wanted to make a comparative balance sheet, as of year 3, the amount that we reported was the amortized cost of 491,532. But in year 4, we report fair value at the end of the year, and that's 501,327. And in addition, on the balance sheet in the shareholders' equity section, we will report the accumulated other comprehensive income, investment in Swan bonds. It's fair value CI. We report $7,888 because that is the accumulated other comprehensive income balance at the end of year 4. That number goes, and as far as the statement of comprehensive income is concerned, these two amounts, which basically add up to $7,888. So in a nutshell, the question had asked for partial statements of comprehensive income for years 2003 and 2004. Well, in the year 2003, since the investment was still being accounted for under the amortized cost model, we reported the interest income from the original effective interest schedule, 34,282. And on the balance sheet, we reported the amortized cost of 491,532. In year 4, right at the beginning, the investment got reclassified as fair value OCI. We calculated fair value at that date and figured the difference as being the other comprehensive income. Then later on, at the end of the year, we again calculated fair value on the investment. The difference between fair value and the original effective interest schedule, the balance as per the original effective interest schedule, equals accumulated other comprehensive income. So, and the change in accumulated other comprehensive income is the OCI for that year. Remember, there was no accumulated other comprehensive income from the past. So the first time when we reclassified the investment, we got $3,364 as AOCI, which necessitated an adjustment for 3,364 to be booked through the statement of comprehensive income. Later on, at the end of the year, we again calculated the balance in accumulated OCI, which turned out to be 7,888. Now, 7,888 minus the 3,364 was the additional other comprehensive income adjustment, $4,524. We didn't do journal entries. They weren't required, so I'm not going to go down the path of recording journal entries here. I want you to be able to figure out the reported numbers uh, without resorting to journal entry. So since both of these transactions or events occurred in year 4, just to make life easier for us, I did not change the date. So December 31st, year 3 is basically Jan 1st, year 4. All right, so I'm going with those with that assumption here. So total OCI is for year 4. These two amounts added together give you 7,888. That's what we reported, both in the statement of comprehensive income and on the balance sheet in accumulated OCI. Okay, so that was practice question 1.